County Board of Retirement meeting for January 18th, 2023. We'll open with a roll call. Ms. Zeller.
Ms. Covison will be absent by prior arrangement. Mr. Hawkins?
Here. Present.
Ms. Cavanis?
Here.
Mr. Dirty?
Present.
Ms. Smith?
Here.
Mr. Cromer?
Here.
Mr. Shoemaker? Absent. Ms. Harris?
Present.
And Mr. Anderson?
Here. Thank you. That'll lead us to the Pledge of Allegiance. Trustee Harris, would you guide us in the Pledge of Allegiance?
I'd be delighted. Ready? Begin. I
pledge
allegiance to the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. Now is the time for public comment on items not on the agenda. Do we have any members of the public that are online that wish to comment at this time, Ms. Zeller?
We have Mr. Shoemaker.
We have him, but we don't see him.
She's moving him.
Oh, okay.
He's coming. There he is.
He doesn't have a camera. Oh, he's the,
Yes.
John is your guy, right?
Oh, John Peronis. Yep.
So we're good. Okay. Hi, Richard. Thank you for joining us.
You bet. I can never get on through the pad at where I am, so come in as a guest originally.
Great.
All right, we'll move on to item number 1, that is adoption of resolution 2023-01, authorizing teleconference meetings pursuant to government code and compliance with Assembly Bill 361. Do we have any trustee discussion regarding this matter?
I move to approve the resolution.
Do we have a second?
Second.
Well, second. Okay. Do we leave them?
Any public comment regarding this item?
There's no public comment.
Any further discussion? Seeing none, we'll take a roll call vote.
Mr. Hawkins?
Aye.
Ms. Cavanis?
Aye.
Mr. Dirty?
Aye.
Ms. Smith?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
And Ms. Harris?
Aye.
Approved.
Very good. That takes us to item number 2, discussion and possible action regarding teleconference meetings and trustees' ability to appear remotely. Executive Director Rensselaer.
Thank you, Chair Cromer. I'm going to turn this over to Board Counsel Jeff Burke.
Good morning, everybody. Thank you. So AB 361, which you just approved for another month, ends the end of February 28th. And so after the February meeting, we'll no longer be able to use 361, which, as you may recall, it was enacted in response to COVID, and it relaxed some of the Brown Act requirements that allow trustees to appear remotely. Normally, the Brown Act would require at least a couple of things if a trustee wants to appear remotely. One is to list the address on the agenda, and 2, to open that location to the public. So 361 relaxed that requirement. Once 361 goes away, a trustee can still appear remotely, provided that they list their address, they open their location to the public. That does create a bit of a technological issue, however, because we have to allow public comment from that remote location. And so maybe I'll pause here. I don't know if Director Rensselaer would like to speak to that before I get to the new legislation 2449.
Thank you, Jeff. So in the event that we have trustees who would like to participate from a remote location, not under the just cause or emergency provisions, but just under the standard Brown Act rules, that location does have to be open to the public, and the public in attendance there would need a way to be able to at least hear, if not also see, the proceedings of both parts of the meeting, what's going on here and what's at the remote location. So we would need to get some technological aspects worked out. So we have equipment there, like a teleconference phone or other, so there actually could be public participation from that location, and they would be able to hear what's going on here. To that end, we also have had some complaints about the quality of the audio from these meetings. Many trustees, it's very difficult when you're on the Zoom end of things to hear what's going on in this office, which means that people watching on the webinar may also be having issues trying to hear what trustees are saying. So first of all, please always speak up. And we also have reached out to IS or IT, whatever they're called now, to get a quote for perhaps upgrading the audio visual equipment in this room, that we might go with individual microphones, so we have better control over the ability to hear trustees. And I think I'll leave it at that, Jeff, unless you have something else.
No, I think that covers it. So the last piece I wanted to mention is new legislation, AB 2449, which took effect on January 1st. And what this legislation does that's different from AB 361, which was really more of an entire body, the entire board creating an exception. This is a much more limited exception to individual trustees if you can meet the just cause or emergency requirements. And those terms are defined in the law. For just cause, there are 4 reasons that you can give to be able to participate in a meeting remotely. If you're providing care for a child or a close family member, if you have a contagious illness, if you have a physical or mental disability, or if you're traveling on business for MCERA, maybe at a conference. So if you can show one of those 4 things, you can establish just cause and appear remotely. There's certain other requirements, and I'll mention those in a minute. The other exception is called the emergency exception, and that's defined as a physical or family medical emergency that prevents a trustee from attending the meeting. If you want to rely on this emergency exception, it actually requires the trustee who wants to appear remotely to explain the reason for the emergency, and then this board must vote to approve the member appearing remotely. There are some limitations on these exceptions. One is they can only be used twice in a calendar year. And in addition to that, the board has to provide for remote public comment like you're doing now under 361. And that also kind of raises perhaps a policy question for the board. Once 361 goes away, does this board want to continue to allow members of the public to provide public comment remotely? I don't want to get into the policy piece, but it's obviously something that that maybe the members and members of the public appreciate not having to come to the meeting to be able to still give public comment. So I'm happy to answer any questions you have. And Director Rentschler, I don't know if you want to speak on the issue of continuing to allow public comment be remote.
We haven't had a lot of public comment. Some systems have indicated that they've had a lot more public engagement since they started offering like Zoom style meetings. We have had some, but I wouldn't say that we've had a huge amount of public comment via our webinar format. We certainly can look at continuing that practice if the board desires. One item, regardless of the emergency or just cause provisions, is that we do always have to have a quorum in person. Is that right, Jeff? So that is one thing to consider moving forward if we go ahead and grant exceptions to attend remotely. Even the standard Brown Act still requires a quorum in person.
Prior to COVID, did people have the ability to comment remotely, or were we just being broadcast?
I believe we had a phone number people could, or no.
Well, the webinar provides a meeting link for public attendance as an attendee. We have to allow them to speak as an attendee. They can also call in on the phone. Again, we have to allow them to talk.
Prior to COVID, when they were all meeting here.
Prior
you
to
didn't have
COVID,
a
we
phone
did
in.
not have that.
Okay.
They typically would come in person.
So I think the question is whether we want to go back to that if nobody has a just cause or emergency. If everybody's here, why don't we just run it the way we used to run it?
That's the board prerogative. That's the question. Do we want to continue to be able to provide remote participation and comment for the public? Again, should we ever have potential trustees, and Jeff, clarify me if I'm wrong on this, even under the just cause or emergency provisions, if we have anybody attending remotely as far as a board member, we still need to provide an audio visual link like we're doing now. So we wouldn't be able to necessarily forego a webinar or a way to provide remote public comment if anybody, as far as a trustee is participating remotely.
I understand.
That's correct.
The webinar also facilitates the live broadcast of our meeting.
Trustee Jordy?
Yeah, I think we should continue to allow members of the public to remotely participate. I am planning to be in person beginning in March. I also have one family get together on the East Coast in the summer, and so my intention is to make that space available to any members of the public who happen to be in that state at that time, and then post it on the agenda. But I don't think, this board has talked about meeting again in that tiny conference room. My recollection is the windows don't even open up in that room. And forget COVID, I don't think it actually, in hindsight, makes a whole lot of sense for 15, 12 of us to be gathering in that little room with no windows that operate, even with the flu going around. So I think we should be staff's had 2 years to identify a larger meeting room. The Board of Supervisors conference room is available. We do not have a board meeting on the day of retirement board, on the morning of the retirement board meetings anyway. And I think we should find an appropriate location with the technology already in place. So beginning in March, we're all there at the appropriate location.
And 1 second before we move on to Richard, Trustee Jordy, is there a conflict at all on the Board of Supervisors when there's closed sessions, they move to the Wednesdays after the main meeting, or is that not on the third Wednesday?
We have 3 meetings on the same day as the Board of Retirement for their special closed session meetings. And at my request, they were pushed to the afternoon so that there wouldn't be a conflict between this meeting and the closed session.
Thank you very much. Trustee Shoemaker.
Yeah, I thank you. As a general comment, and I guess this is to our state leaders, there are counties like Imperial, Inyo, Mendocino, that are San Bernardino, that are monstrous in area. And if you were a resident in Wallala or Covelo, it would take you over an hour and a half to get to our meeting. So to some degree, the distances make it difficult for people to make a public comment for sure. And in part, as far as participation in these meetings as a board member, coming upon full retirement soon, costly travel, an hour and a quarter each way, and the time I'll be submitting reimbursements for the travel for meetings if so required. But I guess the main point I would make is availability of the public to comment from via phone or some other means for our meetings. And I guess last comment is I would support that our meetings continue to be live streamed and people could access through the live stream.
Thank you. Any
Thank
other
you.
trustee discussion? Go ahead.
I understand, I'm sorry.
The only other thing I would add is that I think we've gained some advantages, trustees, of through the webinar, of being able to access consultants and so forth. And for instance, Callan is here today. They may have an expert in a particular area that's only going to be on for a short period of time. It saves a trip up, but it's.
We would always be able to accommodate someone presenting to the board via video conferencing.
Okay, well, my thinking is that given the value of that to the board, that and the technology that we have available, is that keeping it in place, recognizing that we've traveled down the road technologically and allowing remote public comment, it just doesn't seem that difficult, and there's a great value to it. And I agree with Trustee Shoemaker about the 3,500 square miles. It's not easy to get here for public comment.
Trustee Smith?
Sorry.
No.
I'm used to just talking. I've already noticed how much better you're doing because you called Judy Ms. Ella. No, listening to Dan and to Richard and Jim, I agree. I think since we've got this technology and we've already got it in place, that makes sense to do that. I, for one, whatever room we can find, I, for one, like to have everybody sitting around the table so I can see it in. But if public want to observe from a distance and have public comment, that's different to me than having all the trustees in the room. So I think we should allow public comment from virtual and from in the room as well. I just agree.
Is that a motion?
Does it need a motion?
I believe we could probably go with direction given to staff on this item. Are there any other trustees that have similar sentiments as Trustee Jurdy regarding this meeting area and maybe pursuing a larger meeting area where everybody could be comfortable and have a little more personal space and separation?
I do. I mean,
Yeah.
It's nice to know there's an option,
Okay.
a larger venue.
Trustee Cabinet?
Yes, I agree. I would appreciate having a larger meeting room.
Okay. And from my understanding of Trustee Jurdy's comments, I don't believe there'd be a conflict in a county building that already exists with the audiovisual equipment already in place. So I'm hearing some direction given to staff to continue virtual and in-person meetings to encourage public comment, and also pursuing an alternate location that we can post on our agenda with a larger meeting area to allow all trustees to appear in person with more personal space, potentially at the county building. Is that correct from everyone's assessment?
Yes.
Okay, any other comments? Any public comment regarding this item?
There's no public comment.
All right, I believe that will conclude item number 2 with direction given to staff. Takes us to item number 3, discussion and possible action regarding the adoption of the 2023 board meeting calendar. Executive Director Renschel.
The updated board calendar is provided in your packets. This does reflect the change of the November meeting from November 1st, the first Wednesday of the month, to our typical third Wednesday of the month, which is the 15th. I believe that was the only significant change other than correcting a date of one of the conferences, right?
The
December was changed.
December was
December?
changed as well to
Thank you.
From the first week to the second Wednesday.
the
Yeah.
second one.
Is there any trustee discussion regarding the proposed board meeting calendar for 2023? Trustee Cabinet, go ahead.
I don't know if this is an error, but I noticed that for August 28th through the 31st is also signified as a conference, and I don't know, I don't see the conference listed under conferences. So is that
Thank
just
you.
something to ignore?
Never.
Yeah, we'll get that updated for the one that's posted. I believe that shading was in error and we'll
Okay.
that for the version that's posted for the public.
Okay, well, thank you.
Or we'll add the dates if it's actually a conference.
Right, okay.
Thank you.
Very good. Any other trustee discussion? Any public comment?
There is no public comment.
Do we have a motion regarding this item?
I so move.
Do we need a second for consent or just?
That's not consent.
I'll second the motion.
Thank you, trustee Jurdy. Is that with the proposed modification?
Yes.
Okay.
Sorry.
And your second is as well, trustee Jurdy?
Yes.
Thank you. A roll call vote, please.
Mr. Hawkins,
Aye.
Ms. Calvinist,
Aye.
Mr. Jurdy,
Aye.
Ms. Smith,
Aye.
Mr. Cromer,
Aye.
Mr. Shoemaker,
Aye.
Ms. Harris.
Aye.
Approved.
Thank you. That takes us to item number 4, the consent agenda. Our
I'm all ready for that one.
trustee Harris is ready. Our consent agenda will be approved by unanimous consent unless a separate action is requested by any trustee. Do we have any such request? Seeing none. Do we have any public comment regarding the consent agenda?
There is no public comment.
Thank you. So the consent agenda items will be approved by unanimous consent. That takes us to item number 5, discussion and possible action regarding investment matters. I know that we have numerous representatives from Callan here and Mr. Revelis online here. So item A would be the monthly investment report. I believe we'll take that to our financial investment officer, Mr. Revelis.
Thank you, trustee Cromer. Before you've got the monthly investment report and Callan in the room, Claire and Greg will be happy to answer any questions.
Did you want to do the monthly review or go directly to the capital market?
Oh, I'll just mention that, and it's great to see you all in person, that on the monthly flash report, these are still preliminary numbers. They're going to change. The custodian has yet to close the books for the year. A lot of times it takes a little bit more time at calendar year end. And a couple of the private investments are yet to finalize their values as well. So the infrastructure and real estate. So these are very much preliminary numbers. And so the numbers are certainly subject to change. I'd be glad to answer any questions you might have about the flash report before, yeah.
I'm getting awfully tired of red.
These are just temporary. Maybe when they finalize.
Yeah.
Wishful thinking.
Yeah.
You know, I hear you, but there's a silver lining. And that's John Perrone, who is joining us on the call today. And John is a member of our capital market research group. And he is going to talk about our forward-looking return expectations. And the one good thing about last year is it was a resetting of interest rates and equity PEs. So our forward-looking returns are a lot better today than they were a year ago. So that's the silver lining. It's been painful getting there. But when we go through the presentation, you'll see our expected returns are a full 1% higher than they were last year. So huge, I've never seen that.
For your portfolio.
For your portfolio, right? I've never seen that. And I don't think John's seen that. And so that's kind of like the good news of where we're at today. So John is going to walk through our capital market expectations. And this is, we do this annually, but what's more pressing this year is when we come back and see you in February, we're doing an asset liability study. And in the asset liability study, this is the asset side of the asset liability study. What's the expected return, what's the downside risk of different time periods. So when John walks through this, we're also sharing with you real important inputs in the study we're going to be conducting and sharing with you at the February meeting.
Trustee Smith, go ahead.
Your titles changed on the front page. You usually say vice president or something. It says fund sponsor consulting. That's the first time I've seen it. What does that mean?
We have, I have 3 titles. One's a corporate title, you know, senior vice president. Claire, John, and I are all senior vice president. And then we say, okay, what department do we all work in? And Claire and I work, and Hannah worked in something we call fund sponsor consulting. So what that means is it's the unit that works with asset owners like you. Right? And then John works in our capital market research group. That's our the people who do what John does, asset liability studies, and you know, projecting returns in capital markets going forward. Yeah.
What's your third title?
I don't know. What is my third title?
Manager.
Oh, like a responsibility of it. In addition to that, right?
Okay.
So, yeah.
Thank you.
Yeah.
Black hat, white hat, and gray.
So, sorry for the confusion there,
No.
but you're paying attention.
I thought, whoa, did they kick you out of the vice presidency or what?
I think that's a perfect segue for Mr. John Perone, if you'd like to start. Can you share your screen, sir?
I will share my screen.
Claire has you covered.
Okay, great. Yeah, good morning, everybody. Yeah, John Perone, the Capital Markets Research Group. I actually conducted the asset liability study for y'all back in 2016. Yeah, my colleague Gary Chang, who's working on this year's study, he actually sits in the desk next to me. So I have some history with you guys. I think I see a few familiar faces looking out on the screen here, but I must say there looks like there's some new folks too. So if you haven't met me, yeah, nice to meet y'all. So just to tee it off here, let's go to the first slide. Okay, so what are we doing here, guys? So this is really important, as Greg mentioned. What we're going to share with you over, say, the next 45 minutes or so are Callan's forecasts for the capital markets over the next 10 years. Okay, and that's obviously a crucial input into your asset liability study. And so just wanted to mention a few kind of philosophical things. This isn't like a mystery novel. I'm going to hit you on the next slide with, for your portfolio, what are the expected returns for the asset classes? And the intent is kind of dig in deeper to some of the key asset classes, right? Stocks, bonds, talked about those in some detail. Obviously, inflation is top of mind for everybody, so we need to have some discussion on that as well. But when we develop these projections, again, we're not talking about what the market's going to do over the next 3-6 months. We're looking out over a decade, because again, that's an appropriate horizon for you guys to set investment policy. And when you think about projections, you know, we need to have you know, at least an eye on long-term historical averages in terms of what different asset classes are actually provided, and that gives you a starting point. But again, you don't want to fully look in the rearview mirror when you're doing this stuff. You actually really have to construct models for each of the asset classes to give your best estimate of what you think the asset class is going to provide going forward. Now, there's I guess the fundamental linkage inside our assumptions, this should be common sense, is that there's a trade-off between expected return and risk, right? So very conservative asset classes tend to have lower expected returns. So it'd be things like cash, bonds, right? At least over longer horizons have pretty modest kind of ups and downs in terms of volatility. Obviously, the bond market had an outsized downward performance last year, and we'll talk about some of the reasons for that in a second here. And then at the other extreme, right, you've got your aggressive asset classes like equity, right, where over a long horizon, obviously you expect equities to outperform bonds, but then there's that variability that comes from equities, right? And so, you know, your goal in February, right, when you review the asset allocation policy, in a nutshell, it's really, what is that right trade-off between seeking growth in terms of the buckets like equity, real estate, and then you want to have some defense in terms of bonds, right? And then at the end of the day, you also want to have an eye toward meeting your actuarial expected return, which is an expected return of 6.75%, right? So they're all, and these things, these things will kind of crystallize when Gary presents you all the asset liability study, downstream. But just want to tee that up. Okay, and then just at the bottom of the page here again, we have models for each of the different asset classes, and again, I'm not gonna go into. I assure you, I'm not gonna go into the weeds, but I want to leave. What I really want to do is leave you high level intuition in terms of how does Cal inform expectations for equities? How does Cal inform expectations for bonds? So if I kind of leave you some key ideas in the intuition, I think that's probably the best way to go here. So let's, without any kind of further introductory remarks, let's just jump into the presentation in earnest. Okay, so like I said, these are Callan's expected returns and risks for the asset classes that are in your portfolio. We have detail on, like 30 odd asset classes, but, I want to keep things focused on your all's plans. So what you can see is your all's asset classes. And then my understanding is on the table as a potential new asset class is private equity. I know that was part of Gary's presentation back in November. So we've included that as well. And here you can kind of see the good news that Greg alluded to in his introductory remarks, that just looking at equities. So what you see in the table here, that expected return, that third column, that is Callan's forecast on an annualized basis for the return of an asset class over the next 10 years. Okay, so for example, saying we expect the Russell 3000, the broad U.S. equity, to return slightly north of about 7% on a year-by-year basis over that time. Now, in practice, right, that we know those asset classes confer risk. And so what Gary's going to show you in the asset liability modeling is not just what's expected, because we all know you're not going to get what's expected with over time, but show the variability. And that's where that risk comes in. So see that risk of equity, 18%, that think of that as like, that's a standard deviation on an annualized basis where you expect 7, but in good markets, you can get significantly north of that. In bad markets, you get significantly south of that. And you're going to see actually my kind of grand finale, if you will, is we're going to model your current plan based off these assumptions and show you what we expect in terms of return for the plan over the next 10 years. If it's, if we have a benign market environment, what we would expect, and then on that, the downside, what we would expect. And again, when you're setting policy at the end of the day, I would argue what you're really trading off is what you expect versus what that downside is, to try to find kind of a sweet spot in terms of how much stocks versus bonds you want to have. Okay, so that's you see the expected returns for asset classes, and you can see what we've done is compare them to this time last year. As Greg said, we do these on an annualized basis. So for 2022, you can see the equity returns are up about 75 basis points, right? And there's a few drivers from that obviously key driver is the fact that given the equity market went down, 15-20% over the course of 2022, now starting valuations, think of, for example, price to earnings multiples are significantly lower than what they were at the start of the year. So that provides upward pressure or increases our expected return forecast. There's some other effects we're going to talk about downstream, but again, key message, equities we expect to return on the order of 0.75% higher than our forecast last year. The real key change in our forecast, and this really is an unprecedented change in terms of the magnitude, is our expectation for fixed income. So our expected return has moved from 175 last year up 2.5% to 4.25. And I mean, the explanation there is pretty straightforward, right? We all know that last year the Fed started aggressively increasing interest rates, right? And so as interest rates increase, the yield that you're going to get on your bonds is going to increase, right? So it's kind of a bad news, good news, right? There's bad news in terms of that this core U.S. fix represented by the Bloomberg Barclays aggregate. Think of that as just the broad investment grade bond universe, it actually had the worst year ever last year. It was down 13%, right? And that's obviously reflected in your all's portfolio performance over the course of 2022. But again, on a forward-looking basis, far higher interest rates, far higher expected return for fixed income. And it's really nice because fixed income, again, that's the thing that controls the risk in your portfolio, right? That's your primary diversifier in terms of mitigating your portfolio risk. And in the past, right, if you're only getting 1.75% for bonds, right, there's a huge opportunity cost for holding fixed income, right? Because that's going to compromise your overall portfolio return if some chunk of your portfolio is only giving you less than 2%. And now we're in a very different world with expected return of 4% plus. Let me just briefly touch on the alternatives that are in your portfolio. We can always dig deeper downstream, but the note we materially increased the expected return for both public equities and for fixed income. And you note core real estate actually held flat this year. You see that we're forecasting 575 for core real estate. And what that really reflects is the pressure of higher interest rates on funding costs. Okay, and there's also a secondary effect that's a little bit subtle that's embedded in that as well. And this applies actually to private equity too, is that, and actually Greg alluded to this in his remarks upstream, that real estate and private equity are measured with a lag. So when you look at the performance of your real estate or if you do decide to do private equity, those numbers reflect market valuations, back several months ago. And the other piece, for example, with real estate is that those valuations are often based on appraisal values, right? So when you get an environment where we know under the hood that the real estate prices are going down, but people are hesitant to sell, right? So that there's a limited amount of transactions, So the point being that for core real estate, private equity, that private equity has an expected return increase of 50 basis points vis-a-vis last year, but those are influenced by this concept of the lag here. But again, everything in absolute return is either going up or staying the same. And then at the bottom is really a key point, right? Which is inflation. And it's interesting when I go back 2 years ago, our inflation assumption, and again, let me explain what was going on. We're talking about for the CPI, right? So for the baseline inflation assumption, we forecasted 2% inflation back in 2021. And then as market conditions change, we ratcheted that up to 2.25 at the start of 2022. And then for this year, over the next 10 years, I'm underlying the next 10 years, we expect inflation to average 2.5. And I'm going into some detail about that, that it's certainly right. If you talk about what is inflation going to be over 2023, it's obviously north of that. But again, we're looking over a long horizon and we're saying, what do we think inflation is going to average over that time horizon? And again, we'll dig into that deeper downstream. Okay, so that's kind of in a nutshell, where the things are going. And as Greg suggested, the impact of that obviously is to increase your portfolio's expected return. And that, again, that's my grand finale, so I don't want to spoil it. So we'll get to that downstream. All right, okay, so let's dig into current market conditions. And guys, just so you know, there's a lot of slides in this deck, but I think there's about 12 or 15 that are really key. So I'm going to skip a lot of those slides. We can always refer back to them if there's questions or if people want additional details. I don't want to scare you guys taking 5 minutes on the first 2 pages, right? Okay, so what happened in capital markets 2022? I don't think I need to tell you all, right? That again is a horrible market for equities. Obviously, the huge increase in interest rates over the course of the year hurt fixed income to a huge extent. That what was interesting though is that generally, if you look over time, it's very rare that you have both stocks and bonds have negative returns. That you can see that kind of in the middle of the page. 2022 was one example. The other, to find another example, I think you have to go all the way back to, you think back to the 70s, gas lines, oil crisis, back when inflation was, pushing 20%, right? We're nowhere near where we were back. I mean, I vaguely remember my dad having me sit in the car with the Volkswagen waiting in lines and stuff, but I mean, I'd argue it's a very different situation then than now. Okay. I mean, that said, that inflation, it actually spiked up to 9%. If you look, I want to say back in the fall, if you look at the current numbers for inflation, it's starting to go down. Now inflation's about the latest print was 6.5%. If you think about it in terms of underlying drivers, things like oil prices, as you all know, when you go to the gas stations, it's declined materially. That before Russia invaded the Ukraine, oil was $90 a barrel, right? And then you had this huge spike up to $120 a barrel, right? Because of supply shortages, et cetera, et cetera. And if you look today, now we're back to about $80 a barrel, right? So that oil price shock is basically unwound, and it's actually less. Oil prices are less than what they were pre-invasion. Okay. And then if you look at the economic data, I mean, there's no painting an overly rosy picture here, right? The economy is clearly slowing, right? That the huge stimulus that was applied post COVID, right? That's worn off. Obviously, I mean the real kind of break, right, is the Federal Reserve jacking up interest rates, right? You can see that in the mortgage market, right? Those that were fortunate enough to get a 3% mortgage, right now we're talking 6% plus. Borrowing costs for companies obviously are higher as well. So all those things starting to put the brakes on the economy. That I was looking at the Bloomberg this morning. It looked like the retail sales came out this morning for December, and they're actually down 1.1%. That if you look at the most recent wage print, that was all these things are coming in kind of below consensus expectations. So obviously the economy is clearly slowing. I mean, that Apple laying off 10,000 people today. There's obviously some corporate retrenchment going on here. Obviously in San Francisco, we see poor 20-something kids get laid off left and right at some of these, previously high-flying tech companies, right? Okay, let's carry on the next slide. Okay, so this is a key point that I mentioned that, stocks and bonds, obviously, in terms of prices, both went down huge last year. And so you may have read in the press, and there's a lot of discussion about, has diversification failed us here? It's like, hey, bonds are supposed to be my anchor, and they're down 13%. What's going on, right? And I kind of propose a rhetorical question at the bottom of the page there. But I guess the message I want to leave you with is that at the end of the day, the key diversifier in your portfolio, what is going to mitigate the risk in the portfolio is that bond component in the portfolio. That when you look at this graph here, I just want to focus on the intuition that what you see is the correlation between stocks and bonds going back over history. And kind of the intuition is that if the number's 1, they're perfectly correlated. So they work in lockstep. So that means that there's no diversification benefit from holding bonds in a portfolio of stocks. Kind of the other pole, if it went to -1, that means it's a perfect diversifier. In practice, nothing's a perfect diversifier. If you look empirically over history, over long horizons, the correlation between stocks and bonds has essentially been 0. With a lot of variability, admittedly. But my point being that let's focus in on the period after the global financial crisis. So kind of looking at 2009 on, you see this regime, if you will, where there is a huge diversification benefit. Stocks behaving very differently than bonds. And I guess my argument is like this last decade, if you will, this has been the anomaly, right? Because this is the only period in history where we've had interest rates essentially 0, negative real interest rates, meaning that, the interest rate, if you subtract inflation off, is actually negative, right? So what we saw over the course of 2022 is a migration of interest rates back to normal levels, right? If you think about it, you put money in the bank, or, if you're investing in something conservative like bonds, you expect to get a return above inflation, right? Because you're tying your money up, you expect to be compensated from it. You know, I'll show you a slide later that kind of demonstrates that over history. But my point being that on a forward-looking basis, we think the stocks are still going to be heavily diversified by bonds. That kind of full disclosure, under the hood of our asset liability modeling, we've actually incrementally increased the correlation of stocks and bonds vis-a-vis last year, obviously to reflect, you know, this market dynamic that we did see over the past decade. Again, we don't think it's going to persist, but or the more recent behavior, if you will. But again, the bottom line message: bonds are still a very high diversifier. And the other intuition is that remember I said bonds underperformed, had a negative return last year. Now we're at a much higher starting point in terms of yields, right? So if you're getting 4 or 5% in your bonds, you need a material rise in interest rates from here to make you have a negative return.
John?
Yes.
John? Yeah, I think we might have a question or two.
Okay,
So-
very good. Yeah.
Yeah.
Yeah, Trustee Jordy, go ahead.
Yeah. So John, I'm not arguing against bonds being part of the portfolio, but having said that, you know, looking at what happened this year, and as you said, it occurred in the 70s, where bonds and stocks went down at the same time. Jack Bogle, founder of Vanguard, although he was a big fan of just total stock market, you know, obviously first he started out with the S&P 500 index fund, and then went with the total stock market 4,000 stock fund, and that was his primary. I mean, that was almost an entire investment other than bonds, but he did talk about how, with his mutual fund investment book, about how there is a reduced volatility on the downside with value index funds. And we saw that this last year, the Vanguard value index, while the S&P 500, the total stock market, the Russell 2000, they all lost 18-20%.
Yeah.
The value index only lost less than 1%. And so I guess what I'm wondering, because if for me as a private investor, I'm looking at maybe half total market, half value index to hedge against the downside in any one year, why wouldn't the retirement system look at the same thing?
Okay, let me start, and then Greg, if you want to jump in, that would be fine too. That I guess I'd start by saying, again, we're trying to look at this over a long horizon, right? You're paying beneficiaries out in perpetuity. So, and if you look at the historical behavior of value stocks versus growth stocks, if you just look over the past decade, even if you look over the past 5 years, the growth stocks have actually outperformed values, even though, like you said, that obviously value stocks had an exceptional year relative to growth last year. You know, over time, that I think we would argue that you'd expect the growth stocks and the value stocks on a risk-adjusted basis to deliver comparable returns. I guess the key piece, I guess, embedded in your argument is that there's an element of kind of tactical. I think the market's going to do poorly now, so let's tilt our portfolio into value, because yes, they do have more defensive characteristics than growth. But again, that's dependent on you kind of making that timing call right in terms of when to get in, when to get it out. If you are concerned about the portfolio risk in your portfolio, or the overall, as appropriately you should be, I guess I would argue now with core fixed income returning above 4%. I mean, that essentially has, this slide showing essentially is uncorrelated with stocks over long history. Whereas if you look at the correlation of value stocks versus, say, a broad index, that's going to be like a 0.9. So there's not going to be as much diversification benefit. Let me pause there and see if the field consultants have anything to add to that.
Yeah, so I think there are a couple things here. Yeah, so deep in my heart, I'm more a value person than a growth person, right? The price you pay for whatever you invest in is really important. But the cycles between value and growth can last a long time, and longer than most people can hold that position. So if you overweighted a value index relative to the broad market or a growth index, you would have been wrong for 9 calendar years. And then this last year, you would have been right. And most people can't hold on for 9 years. And on top of that, the growth indices, I'm looking at the report we only showed small cap here. Even with last year's bigger dislocation, at least in the mid cap space, over the last 5 years, growth is still outperforming value, even with that big correction. So, what the Jack Fogle's book is founded in accurate historical data. And I have a lot of sympathy for it, but at the end of the day, we have a preference to invest in the broad market instead of like investing in like small slivers of it.
Mr. Reveles?
Yeah, I wanted to point out for Trustee Jury that we do have approximately 15% tilt towards the value managers. So, MSERA has got a broadly diversified portfolio. We've got a solid footing in the value.
Very good. Any other discussion from trustees before John moves on?
And John, I just also want to be mindful of time and,
Yeah.
maybe hit on the key points.
Yep, understood. Let's actually carry on and jump to slide 9. Let's talk about inflation a little bit and where our inflation forecast comes from. Okay. And so we assess, we come up with our inflation forecast looking at a lot of different directions and kind of composite them together. That kind of the first place you want to look for inflation forecast is listen to the market. What is the market telling you? What is the market consensus inflation forecast? And that's what you see depicted on this slide on page 9. And so what this shows, and again, we're forecasting out our asset liability study over a 10-year horizon. So we're going to focus on a 10-year forecast here. So the market's current forecast for inflation over the next 10 years, that it's a bit under 2.5%. And where that comes from is you can look at the difference in the yield in a 10-year treasury bond and the 10-year TIP, which is inflation protected securities. And the way a TIP works is it gives you its yield plus inflation. So if you think about it, that what that break-even inflation is that extra yield the nominal treasury would have to earn to give you the same purchasing power as a TIP. Okay, and I actually just looked. I was just looking before the meeting on the Bloomberg that I mentioned that the current inflation forecast based off the market is a little bit south of 2.5%. Actually, it's the current 10-year as of 8/12 a.m. was 3.4%, whereas the yield on the 10-year TIP was about 1.2%. So the current market expectation is about 2.2%. Based off the market, okay? But we don't want to focus solely on the market. Again, we want to kind of be tackling this, whatever, feel the elephant from different directions or whatever the analogy is, right? So we also want to look at what's historical inflation been, okay? And if you look, for example, again, we want to look over a long horizon. If you look at inflation over the past 25 years, and this is a number through December, which embeds the inflation spike that we've all experienced over the past 12, 18 months, inflation is 2.6% for CPIU over the past 25 years. Okay, so you have kind of 215 from the market, 2.6 from kind of a long history. And then we want to keep an eye to what is the Fed actually trying to do, right? The Fed is trying to target a policy rate of 2%. Jay Powell's been pretty aggressive, at least in his language, in terms of, yes, that is our goal, but we recognize in practice when kind of push comes to shove, right? If it's a question of wrecking the economy or maybe backing off on being aggressive in terms of raising interest rates to try to squeeze inflation out, at least our view is they may err on the side of trying to support the economy a little bit, as opposed to steadfastly, our sole objective is to keep it 2%, right? So as I mentioned upstream, our inflation forecast kind of balances all these factors. So our inflation forecast over the next 10 years is 2.5%. Again, it represents an increase over last year and an increase over the previous year. But again, over a decade means that inflation's well grounded. So let me pause there because I imagine there might be some questions on that. Okay. So again, I'm gonna kind of scratch the surface on some of the, remember I promised you that we'll look a little bit at the models for fixed income and equity and try to convey some intuition. So I'm gonna do that at a high level here. That let's go to page 11. And there's a lot of numbers here, but there's really just one number one row I want to focus on here, which is what are you guys invested in? Okay, so you guys are invested in your benchmark for your fixed income portfolio is the aggregate. Okay, so you see that under that second line in the table. Okay, and so you can see top line in the box, our forecast for expected return of 4.25% over the next 10 years. You can also see if you look to the very right-hand side, see how that's 2.5% higher than our forecast last year. And again, at the end of the day, you can kind of do lots of math on the bonds, but if somebody put a gun to my head and said, "Hey, John, what do you think the return for the aggregate's going to be over the next 10 years?" I would say, well, a good first approximation is what is it yielding now? Okay, and so in terms of the income return for the bonds, you can see that's about 4.3%. That we are forecasting at the long end of the curve that we expect interest rates to increase. Remember, I said that the 10-year right now is 3.4%. We do expect that to increase a bit over the next decade. That the term structure will revert to kind of more normal historical levels. And so what that means is, if there is some sort of incremental, if we start today and the interest rates for 10 years is, let me keep it simple, 3.5, and we say we think it's going to go to 4.25 10 years from now. That means that as interest rates go up, you will take a bit of a hit on the bond price from capital appreciation loss. And you see that reflected here. But again, in a nutshell, bond returns significantly higher, again, driven by the fact that the starting yields are higher. And the rest of the section goes in a lot of detail and nuance about the models, but I think if I can kind of just convey that kind of common sense intuition, I think we're probably okay on bonds, barring any additional. Let me pause and see if there's any detailed questions on the bond forecast. Okay, so let's transition to equities. And then we get to the grand finale. What does your portfolio look like? Okay. And we alluded to this in some of my initial remarks, when we had the kind of the answer slide up front that had all the assumptions. We alluded to the fact that valuations sitting here, January 18th, 2023, significantly lower than what they were at the start of last year. And there's a variety of ways you can skin the cat, right? You see here kind of 6 different standard valuation metrics for the equity. This is for the S&P 500 for the U.S. equity market. And the point being, if you look across all these metrics and compare them to long-term historical averages, pretty close to long-term averages in terms of valuation. I mean, that said, you can see the fact that equity markets went down last year. You see that blue line represents the just picked one here. This is the forward price to earnings ratio. You can see it was elevated last year. And that was actually reflected in our expected return assumptions. We actually had a haircut on our S&P 500 forecast to reflect the fact that valuations are high. But now when we look here today, you see the valuations pretty much normal. So we've taken that kind of negative valuation term out of our equity forecasts. So that's one thing that's driving our equity forecast higher from last year. That one thing to acknowledge is kind of if you look at the second bullet point at the bottom of the slide, yeah, we're near the long-term averages now. But if we do enter a recession, right, those earnings forecasts are going to decline, and likely, there'll be some more downside to the equity market. But again, we're not talking about what's going to happen over the next 3-6 months. Again, we're looking over a long horizon. What do we think a reasonable return for the equity market is? Okay, let's go to the next slide. Let's skip that slide. Okay. And again, a lot of information on a table, but I'm going to try to distill it down. Okay. Don't even look at the table for now. Just, okay. If you think about, I want to say, what is the expected return? Where's the return I'm going to get from a stock? Okay. It's going to be a combination of two things, right? You're going to get income from the stock, and then hopefully you're going to get capital appreciation, the fact that stock prices tends to move up over time. Okay. And so the way we incorporate in our model is that we look at the sources of income for each of these indices. And again, let's just focus on that first line, which is the S&P 500. So you're going to get, so on the income side, the most obvious thing you get is obviously the dividend check you get, on a quarterly basis from the stocks, right? So we're forecasting that to be on the order of 2% a year over the next 10 years. Okay, so there's 2% coming from dividends. That if you look historically over the past decade, particularly for the U.S. market, that there's been more buybacks than new share issuance. So to the extent that shares are getting taken out of the market, okay, that's going to decrease the supply, increase the price, and so that's reflected in 50 basis points as well. So from the income side, I think you're getting about 2.5% from the U.S. stocks. That one thing that is interesting, we haven't talked about international markets. We can kind of segue there in questions downstream if y'all want. International markets tend to have significantly higher dividend yields than the U.S. stocks. And one piece of that intuitively is that the U.S. index tends to have more tech companies, right? Tech companies typically don't pay dividends, or if they do, it's tiny. Whereas in Europe, there's a lot less. For example, in Europe, there's a lot less tech in those indices. The reality is that valuations in international markets, if you look at PEs, they're significantly lower than the PEs in the U.S. as well, and so that tends to increase dividend yields as well. So a lot of what you're getting in terms of return on the international stocks, particularly we're talking about developed markets, is looking at those dividend yields. Okay, so the forecast expected return, we need to sum up the income. We need to add in the forecast for capital appreciation. Okay, and so our forecasts are nominal forecasts. They incorporate inflation. So think of inflation. So we need to add inflation in. And we just talked at some length of why our inflation forecast is 250 over the next 10 years. So we got 2.5. We add 2.5 for inflation, that gets us to 5. And then the last piece is that we assume that over time that the growth in real earnings is going to be linked to the growth in GDP and the economic output of each of the regions we're forecasting here. And so our forecast for GDP growth for the U.S. is 2.25% over the next 10 years. I think pretty consensus, that at the end of the day, you can forecast GDP growth. You want to just chop it into like population growth and then changes in net productivity. Those things actually govern what the change in GDP is over time. So pretty modest population growth, productivity growth, a little bit south of 2%. And so you add all those things together and you get to 725. Okay. And again, when we're coming up with these forecasts, we're not just looking at one model. We're trying to look at things for a lot of different directions. So let me just give you some color, because remember at the very start, we like to inform our expectations by history in terms of what has over a long horizon, what has been a reasonable expectation. Okay. So for example, if you look at what the expected return for the S&P 500 has been over the past 25 years, a lot of, we had some bull markets. We obviously had tech crash 2001. We had global financial crisis 2008, COVID, a lot of crazy stuff, right? But a lot of ups and downs. The annualized return for the S&P 500 over that time period is 7.5%. Okay, on a nominal basis. as I mentioned earlier, inflation, has been about, let's call it 2.5 to keep the math simple. So on a real return basis, historically, the U.S. equity market over the past quarter century has returned 5% real a year. Okay, and what are we talking about with our forecast here for the S&P 500? We're saying that we're forecasting 725. Again, our forecast for inflation is 2.5. So we're forecasting basically 4 3/4 real return for the S&P 500. So very, very consistent with history. And actually, my statistic about the 5% real return, there's actually a broader study for equities. There's actually a broader study where these guys at the London Business School, they looked at 120 years of data going all the way back to the turn of the 19th century and across 24 different countries. And when you look at what was the average real return across all those years, across all those countries, it was 5% real as well. So again, we've used a model-based approach to get us a number very close to 5%. But again, I want to kind of leave you with that idea that, or a rule of thumb, that a long-term expectation for equity return over time, at least based off history, is 5%. Okay, so I didn't want to belabor that, but I think this is your biggest asset class. So this number is super important, obviously, in terms of the modeling and your portfolio outcomes, to be honest. So I wanted to spend a bit of time on that.
Yeah. Hey, John.
Yes.
I think we have a question, and then I might move us forward a little bit if you don't mind. So.
Yep.
Trustee Jurdy.
Yeah. No, the next slide's the grand finale, so we're in good shape. But yeah.
All right.
Fire away.
Well,
I didn't up too much.
All right. Well, so back to the Vanguard large and medium-sized value fund. So these are not small value. These are not volatile. These are pretty much blue chip companies. Think Berkshire Hathaway. Don't think, fly by night.
Yeah. Exactly.
Small cap value company that may or may not go out of business. That index fund over the last 10 years was over almost 12%. Return. It was only 17 basis points less than the total stock market during the same 10 years. And it was only 76 basis points less than the total stock market over 15 years, according to Morningstar. And again, it does seem that there, I'm just asking you to tell us what your research shows, but I mean, it seems like the value funds don't take the same dip. And since we are in a position where we have to pay payments to retirees every year or every month, and whether our volatile stock portfolio is down dramatically or not, we make those monthly payments. It seems like reducing the volatility has some value beyond just the total returns. And when you look at the total returns being so close to the total stock market, it seems to me that reducing our bond portfolio with an extra 2% in projected returns in the bond portfolio. I look at Morningstar and they're saying the Barclays total market for bonds in the last 10 years was 1%. And over 15 years, I think it was like 3%. So, there's multiples of value of extra compounded interest value from the value fund, above and beyond what the bond market produces. So it seems like a reduction in the bond portion of the portfolio and a specific index for high quality value stocks seems like it's a better bet.
Yeah, I think all your points are spot on, Trustee Jurdy, and the way we look at this and think about it is we do our capital market expectations on an annual basis. And we model broad asset classes. And then we do an asset liability study for you that looks at how much we allocate to broad asset classes. And then after that, we do work to say, well, what do we do within each asset class? So kind of the workflow would be, okay, John does his work, capital market expectations. Gary's here in February. We look at broad asset allocation. And then if you all want to look at, well, should we overweight value within equity? We would do that as a step after that when we do what we call a structure study. Right? So, and we did this whole thing with you all the last time we did an asset allocation study. Asset allocation, and then you look at each asset class and decide how we want to model and allocate within the asset class. So if you all want us to look at having a value overweight, we could look at that after we do the AL study. But I think that, Trustee Jarrett, and apologies if I ever called you by the first name. But, you know, so we can, I think everything you said is spot on and accurate, and we'll just look at the trade-off of that a little bit further down.
And just finally, the reason I'm bringing this up is because nobody knows the future. What we just saw might not happen for another 40 years, but it might. There are some people who think that the Fed will be under pressure not to hold interest rates or not to raise them as high as they probably really need to. And then we could see a reoccurrence of high inflation and then a raising again of the interest rates, which is what I believe happened in the 70s. And you know, so if that scenario unfolds, we could see bonds having short-term yield problems again because the interest rates are going up. People don't want to hang on to older bonds that have a lower yield. They're buying the newer bonds, which is what we saw happen here. I agree. The interest rates today are higher, so the spread won't be as great as we just saw in 2022. But it could happen again at some level, and essentially yield nothing in our bond portfolio again for another year if that keeps happening, and for 2 or 3 years maybe if this thing gets protracted. So I'm just saying, I think, to me, the logic is we are reduce our bond portfolio by a little bit and shift some of our total market index, some of it over to blue chip, high quality value stocks that are likely to retain most of their value in a struggling market.
Trustee Smith, as well.
I had a real simple question. I can't follow Dan's. I'm just looking at the chart at the bottom. I didn't know if we were going to look at that or not. ERP, equity return.
Yeah. That's I think this was just an example of providing historical context, and that's why I mentioned if you look over the past 25 years for S&P, the real return has been 5%, and if you look over a much broader horizon across different countries, the real returns have been about 5% too. That if you look at this particular sample, I mean, these things depend on when you set the endpoints. You can see that the U.S.
Hey, John, one second. One second. So it's equity risk premium. So that's how much stocks earn over whether it's cash or a bond.
Okay.
So to take on that equity risk, what are you getting paid relative to buying real safe stuff, whether it's cash or bond?
Okay.
So when John says, you know, real return has been, or the equity risk premium has been, it's kind of like the trade-off of having a risky asset versus safe.
Yeah.
Gotcha. Thank you.
Yep.
Mr. Rebels.
So I wanted to go back real quick to Trustee Jarrett's comments. One thing to keep in mind about how you want to think about this is also with the correlation of stocks and bonds. 2022, that correlation broke, but in the last downturn in 2020, that correlation held. And so we were able to actually pull from inflated fixed income funds and rebalance into our equity funds.
Yeah.
So 2022 didn't work so well. 2020 worked just fine.
Yeah, 2020 and also, 2001 tech bubble, 2008 global financial crisis that, had that graph of the correlation. You can see this huge downward spike in each of those because fixed income in most circumstances does provide this flight to quality effect that was just alluded to in the comments, but it's not immune to the Fed deciding to raise interest rates, cash rates by 425 basis points, right? We've seen biggest rise in such a short period in memory, right? So The bond math is what it is. And again, I would argue in a forward-looking basis, bonds provide, you're trying to get to 675, right? That's your discount rate. And you can, in bonds, we're suggesting we expect them to return 425 over the next decade. That only means there's 250 basis points more you need to get to 675. So I guess my inclination would be to retain the bond portfolio at least at its current weighting. Again, given all expected returns have risen, so you don't necessarily need the portfolio to work as hard as maybe it did in the old days. And Greg, or they've shot to the answers here. That yeah, so you can see again, we're projecting the expected return of the portfolio over the next decade to about 7%. So about a quarter, or that's 1/4% higher than your discount rate. Now, you got to say both at the same time, risk and return. You just can't say return. I'm going to show you on the next slide some intuition in terms of how they're related. But the portfolio has volatility, right? I mean, the reality is you look at it, you got 21% in kind of your lower risk anchor, the fixed income, and the other 79% is in growth assets, which intrinsically are going to have a high volatility. So, and again, good news being that the expected return is again a full 1% higher this year than it was last year. Let's go to that last slide of the presentation, which tries to convey some of that intuition. Okay, and so here what we're looking at over different time horizons is what that forecast means. Okay, so there's an expectation, but then there's the good markets and the down markets. As you might, if you look over a 1-year horizon, as we all know, we saw last year, right, that there can be quite a bit of variability in terms of the return of the portfolio in terms of up or downside, right? So, and this is kind of a measure of how risky your portfolio is. Just for intuition, see that 90th percentile at the bottom there? That represents a bad market environment. Think of that happening, for example, 1 year out of 10. And look, this is saying your total portfolio, all this diversified portfolio is going to underperform by 10%, and that's kind of what happened last year, right? But the good news is, right, as you move out over time, you move from a 1 year out to a 10-year horizon, you're not going to get 10 bad years in a row. They're going to start, good years and bad years will start to even out. And so what it means is it starts to compress the realized returns of the portfolio over time. And that's what you see here, that over 10 years, here we're talking about on average, there's that 7%. And then, except if a period of exceptional performance, and all this stuff's going to be linked into the asset liability stage, just so you all know, because we don't want to focus on the expectation. We want to focus primarily on the expectation and what happens if markets go poorly, right? That kind of 90th percentile, that bad case, right? So here, even over 10 years, the downside is about 2%. The portfolio returns 2% a year. Now remember, that's nominal though, and I said inflation is 2.5%. So what we're saying is there's a 1 in 10 chance the portfolio actually doesn't beat inflation over that horizon, but that is embedded in the type of risk you have to put in your portfolio to try to capture that 6.75-7% return over time. And then lastly, just touch on one final thing. See that this is a probability of you beating your discount rate over time. And it should be intuitive. If the portfolio is running at a 7% expected return and your bogey or hurdle rate is 6 at 75, there's a little bit better than 50% chance of beating it over the next decade. But again, that number is probably lower than what you would intuitively think, and that's the investment risk flowing through into the outcomes. Okay, so I guess I would argue that given Callan's expectations are very harmonized with the inputs that went in by Siegel into y'all's actuarial projections. So at least for me, I don't see any cause to change the discount rate given how close the Callan's projections are with the actuarial return on assets. So with that, I think I'll close. So again, good news going forward. Now you actually have a greater than 50% chance of being the ROA of a decade. Last year, I couldn't tell you that. but again, we had to take some pain to get there. So I appreciate your all's time and happy to entertain any final questions.
Thank you, John. Do we have any other trustee discussion? Go ahead.
I know that this is short term, but there is talk out there about the current Congress holding the debt limit, not moving it. And I just wonder if you can give us some clarity. Were we talking about the horrific outcomes that are being threatened if that happens?
I think most market participants, stock market participants, bond market participants I hear from think it's a bluff, and because it's been a bluff for decades.
Yeah,
Right? That this is all blustering and negotiation tactics. Now, having said that, the very small possibility that they do something, it could be extremely destructive to the long-term borrowing costs of the U.S. government, and it would be very disruptive for the economy. So, I mean, hopefully it's a bluff. If you can predict what's going to happen with politics, but I think that's where we're at. Where it is one of those black swan things, very low probability that could be.
Like COVID.
Yeah.
Hey, Greg, what about this virus? What do you think is going to happen?
Go ahead, Trustee Smith.
Just a comment, whatever formulas and algorithms and computer programs and whatever you guys use, I'm impressed that we can forecast out. And I really appreciate it because I'm a numbers person, but there's a lot of detail in here that I'm glad I didn't have to do.
That's John.
Thank you, John.
It's our pleasure. Yeah. And
Trustee Anderson.
I guess the one message I'd leave with you is, again, we're forecasting these expectations, but embedded in the modeling is we have to capture that risk, right? And so when Gary presents the asset liability study this week, don't just focus on the expected, focus on those downside cases, because that's where you really tease out what your risk tolerance is, because obviously 100% equity is going to look better on average, but it's those downsides. And I think one of the comments was about, hey, we gotta mail checks to our participants every month, right? So there's only a limit in terms of how far we can push down the gas pedal. Again, I argue with these new capital market assumptions, and given your discount rate, you don't need to jam the pedal to the floor to meet your actuarial hurdles, I would argue.
We had a discussion. Trustee Anderson.
Yeah, mine's just a comment, and John and Cal, thank you. Is it as we go forward in this study, is it the most important thing that John said that I picked up was that if you model this back over the last 120 years, you see some consistencies here, and that's been a time of world wars, pandemics, changes in economic powers, governmental control, all of those kind of things. And I think as trustees, as we sit here, we look at daily news reports, and we're seeing, population collapse, and what's that going to do to productivity, and what's the Fed going to do? And there's a lot of information out there that tugs us in the short term. I think Cal does an excellent job with the quantitative analysis to forecast for a 10-year period. But I think we have to, again, part of our strategic mission is to have a long-term view, and some of these numbers hold up over significant global changes over 100 years. And I don't want to forget that as again we get bombarded with all of these things that it causes us a lot of angst in the short term. So as we go forward, I hope we'll remember that.
I'm not seeing any members of the public attending, so I don't think we need to ask for a public comment. Any final closing remarks, Claire or Greg?
No, thank you so much. And we look forward to visiting with you again next month with Gary to talk about the study.
Very good.
Excellent.
Thank you. Great.
Good to see you in person.
Thanks very much.
Thank you, John.
My
you.
pleasure. Thanks very much.
I think now might be a good time to take a quick break to stretch our legs. It's almost 10 o'clock, so how about we come back at 10:05?
Good job. Good. Good stuff. Thank you.
meeting. It is 10:08 a.m. The next item on our agenda is item number 6, discussion and possible action regarding consulting actuary and actuarial audit services. Executive Director Rensler.
Thank you, Chair Cromer. I'm requesting board direction regarding MSERA's contract for actuarial services. We are actually due for an actuarial audit, and our contract with our consulting actuary is ending with the 3-year experience study that they're completing with data that ran through June 30, 2022. Staff is requesting a 3-year contract extension with Siegel with requirement to RFP once the 3-year extension is completed. And we're requesting direction to engage with Chiron, who is the auditor who performed the last actuarial audit. And our estimated cost, and these costs are actually included in our budgets, is approximately $57,500 for the actuarial audit, which will duplicate the June 30, 2022 valuation, and also the economic and demographic assumptions that come out of and are set by the experience study. We do not expect necessarily to have the actuarial audit available before we need to contract for consulting services, which is why we're requesting the contract extension prior to you receiving those audit results.
Right.
Chairman,
Go ahead.
I'd like to move staff recommendation. I'll second that. I think that's wise to go on.
Do we have any other discussion from trustees? Still seeing no attendees on our meeting. I'm going to assume we have no public comment there. A roll call vote, please.
Mr. Hawkins?
Aye.
Ms. Cavanaugh?
Aye.
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 Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Harris?
Aye.
Thank you, approved.
That takes us to item number 7, discussion and possible action regarding compensation earnable and pensionable compensation resolutions. We have 2 items before us today. Those are resolutions 2023-02 and 2023-03. Would you like to offer any further explanation, Executive Director Rensler?
These are just new pay codes created from the labor negotiations. Most of them are longevity codes. If you have any questions, I'm happy to entertain them. These codes would all be pensionable for both our pre-PEPRA members and our PEPRA members.
Have any board member discussion regarding these items? No public in attendance, so we'll continue. No public comment there.
I think we can do one motion for both resolutions, right?
Mm-hmm.
We'll entertain a motion if anyone's interested.
I'd be glad to move that we adopt the resolution 2023-02 and resolution 2023-03 for pensionable compensation.
I'll second.
And then a second.
I'll second.
Thank you.
Heard. Thank you, Trustee Cavanaugh.
Thank you.
Any further discussion from trustees? I'm not seeing any hands raised. Go ahead with a roll call vote, please.
Mr. Hawkins?
Aye.
Ms. Cavanaugh?
Sorry, aye.
Mr. Dirty?
Aye.
Ms. Smith?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Approved.
That takes us to item number 8, discussion and possible action regarding the application of the PEPRA compensation limit policy. So this was prepared by Executive Director Rensler. If you'd like to present.
Thank you, Chair Cromer. And a little bit of background, PEPRA requires the maximum compensation limit for PEPRA members that can be used in calculation of the retirement benefit. While we have addressed this using an annual cap on the compensation and contributions in the payroll system, the way it reports in our pension system has created a number of issues. So we have looked at a variety of ways to address this. At this point, I've moved forward with utilizing a cap on the amount of pensionable wages per check in the county payroll system, which will improve the reporting of our data in our database, which will correct deficiencies in the calculation of final average salary and issues with the calculation of final average salary in the member self-serve portal. However, that is not a perfect solution, and the policy does address ways to remedy, let's say, an instance where someone receives a one-time special pay that is pensionable that might have kicked them over the cap for that check, but they're not going to be capped on an annual basis, and the policy outlines how we would go about correcting that. So I'm looking for support here to adopt the policy, accepting the limitation to apply the limitation of the annual cap on compensation for PEPRA members on a bi-weekly or per check basis.
So for further discussion, my understanding is the current way that's calculated is there's a limit or an amount that they contribute per year annually. When they reach that amount, then no further withholdings go into their retirement for the remainder of that year. Is that correct?
That's correct. We pension their full paycheck until they hit the cap. There's a prorated check typically, and then nothing occurs for the remainder of the year. This would essentially distribute their income consistently over the entire calendar year and contributions. Yes, sir.
Does it create any issues if someone, for instance, leaves employment or transfers to another employer, reciprocal system or anything like that? Does that need to be like reconciled at that point?
I think this improves the reporting even for someone who leaves in a mid-year scenario. Part of the issue, including the conversations that I had with our actuary, is that the reporting of biweekly compensation that exceeds on an annual basis the annual cap results in a skewing of the calculation of the final average salary that could result in an actuarial loss to the system. The method being incorporated with this policy eliminates that actuarial loss.
Trustee Jurdy?
I guess I'm kind of curious. I mean, the cap on benefits is pretty high still, even with PEPRA. How many are we talking, like 5 or 50 people that this applies to?
It's estimated in the neighborhood of 12 to 15 right now with the county based on last fiscal year data, and it changes a little bit from year to year because the cap goes up. We will have instances where somebody may have been capped in 2021 but didn't get capped in 2022 or something like that because the cap went up and maybe their salary didn't. So it fluctuates a little bit as to who is affected in what year, but on average, I'd say there's at least 12 people in the county subject to the compensation cap.
And to feed off of that question, that cap for the yearly compensation is set by the state, is that correct?
It's actually set in PEPRA as far as the formula, but then they didn't want every serial system trying to apply that formula independently. So the California State Actuarial Advisory Panel actually does the calculation and provides it to all of the serial systems. So yes, it is a branch or an affiliation of the state government that is doing that calculation to determine the compensation.
You have a question? Okay. Any further discussion? I understand this can be a complicated matter. Go ahead.
By changing it or before changing it, were we having trouble calculating the right number?
As it stands currently, Pension Gold calculates an incorrect final average salary, and Member Direct will calculate an incorrect final average salary. The Member Direct, because someone is projecting an estimate until their anticipated retirement date, uses the last pay period's reported wages. So it's either projecting their full salary or we're projecting zero, both of which cause incorrect estimates for members. And it requires more manual intervention on staff side to do a calculation for the final average salary that would be eliminated if we move to this process. The benefits have not actually, we've not retired anyone subject to the PEPRA cap, so we have not incurred any actuarial loss or used an incorrect salary. This was just trying to get out ahead of it and address it in a more holistic manner rather than trying to address it in a one-off or workaround outside of what the system does.
And this will fix that, and Pension Gold and Member Direct and all that will be changed.
Yes, because this will report that income every pay period for the entire year. It now eliminates a zero period, which would be used for projection in a Member Direct estimate or their full salary, because it's going to use the current capped biweekly salary in those future projections.
Okay, that's good.
So the way I understand it in my thought process is this is more of a smoothing out over the 26 pay periods that county employees encounter each year, instead of basing it off their salary and withholding more money of their own contributions and then reaching the limit and then not contributing anything at all.
Correct.
So sort of smoothing it out. So in a sense, for some of those PEPRA members that the 12 or 15 members that might be impacted by this, it is a smaller contribution per check, but the same contribution for the year, instead of reaching it faster and then not contributing to the remainder of the year.
That's correct. Ultimately, the amount of pensionable income being reported for the year is the same, and the contributions paid are the same. This improves the reporting of it by having it distributed throughout the entire calendar year, which results in better data for PG to calculate the final average salary and better information when a member does their own estimate in Member Direct.
And personally, it sounds more reasonable to me that it's the same amount per check that the employee can count on, instead of having that roller coaster ride throughout the year, and then at the end of the year, their take home drastically increases because they're not doing their own personal contribution to their retirement at that time. So, and payroll from the county side is all on board and ready to execute this.
They actually did execute it with the check that came out on Friday of last week.
Okay.
Oh, so what if we say no?
Then I'm SOL, because I did not expect the county to implement it, quite honestly, with the changes in their payroll staff. I wasn't sure they were going to have an opportunity to get to this. In late December, they contacted me and said, we've talked with Tyler, we understand, and we can run your test, and then they put it into effect. So I appreciate all the assistance from the payroll staff with the county.
Very good. Is there any other trustee conversation or discussion they'd like to have regarding this matter?
Thank you, Mr. Chairman. I get it now.
Okay. I see no members of the public in attendance, so we can move on from the potential public comment. If there's a motion or anyone that would like to propose one regarding the PEPRA compensation limit policy.
Move approval.
Second.
We have a motion and a second. Seeing no further discussion or hands raised from trustees, can we do a roll call?
Mr. Hawkins?
Aye.
Ms. Cavanis?
Aye.
Mr. Dirty?
Aye.
Ms. Smith?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Approved.
Thank you. The next item on our agenda is number 9, discussion and possible action regarding the mission statement and strategic plan. We will go to Executive Director Rensselaer again.
Thank you very much, Chair Cromer. Back in February of 2022, this board met and went through a comprehensive strategic planning day-and-a-half long session and established our strategic plan that covers a 5-year period. Because this item was on our agenda for review and we had a couple of newer trustees who did not participate in that, I thought this was a nice opportunity to just review what the outcome of that SWOT analysis and day-and-a-half long session was. Our mission statement, vision statement, guiding principles, and the goals from the strategic plan are provided. There is no action needed on this, although the board could take action if they felt that there was some need to change any of these components. They were just created not quite a year ago and adopted for the 5-year strategic plan for fiscal years ending 23 through 27 or something, I think.
Thank you, Trustee Smith.
Yeah, I think it's good just to bring it back so we can all review it, not just the new trustees. It was good to read all of those again.
Would you like this returned every year?
I would personally, but I don't know better, but yeah.
I think it would be a good idea at the beginning of the year, just as a subtle and constant reminder of what we all agreed to do.
Yes.
And then we don't have to search through our documents that we get sent 8 months ago to try to find it. So I like that.
Subtle, we put the mission statement at the bottom of your board cover letter, just so you know, okay?
Is there any other board member discussion regarding whether it's presented? It's not an action item, so we can receive and file if there's no comment or direction. Seeing none and still no members of the public in attendance, I think we'll take item number 9 as received and filed. Item 10, board work plan and strategic calendar quarterly review, Executive Director Renschel.
Thank you again, Chair Cromer. This is the quarterly review of the board strategic plan and the board and staff work plan. This is again receive and file unless the board has direction regarding it. The strategic calendar covers the rolling coming 12 months as far as things that may be turning up on your agenda. Items that are strategic plan related are typically in bold and or shaded in a green cell. On the quarterly work plan, there are 2 action items that currently show a yellow dot, meaning they're slightly behind schedule. Those items are still in progress, and I expect to have those completed still by the due date expressed in the report. We're working on the member handbooks as we speak with staff, and on the feasibility and benefits of an internal audit function. I've done some preliminary work, but I need to get back to that to bring something to the board regarding what I found out in the feasibility for getting board direction on that. I do expect to still complete that by the end of the fiscal year 23. So by June 30th.
No red dots. That's good.
I think Richard has it.
Trustee Shoemaker.
Yeah, the process on the handbook, once you get a draft together, how do you intend to proof it, have it interpreted before you bring it in for an approval by us for publication? And the reason I raise this issue is in some past handbooks, some of you might remember this, the verbiage in some of them later in regard to health benefits came up to be interpretable in a couple manners. And it led to some very serious problems for a couple years within the county system. So just when they hear about the process, we're going to take all the way through this.
Well, the process here involves using senior staff to write and develop a lot of the material for the handbooks. We will eventually go with a specific handbook for actives and a separate handbook for retirees because their questions and issues are different. We'll be rolling out the active handbook first. And that process for review is usually using senior staff and myself to make sure that it's clear and understandable. We can engage with some of our newer staff to make sure that they understand it and it's clear as far as the intent and meaning behind certain sections. I welcome any suggestions you have on how you would like us to approach that if you have something specific you'd like to include.
A lay interpretation. Having the most educated staff about the retirement system is great on one level, but and maybe a lawyerly interpretation as well of any and all of it. And I hesitate a little bit to this one, but maybe run it through SEIU or some other of the represented groups.
I'm happy to.
Go ahead. I'm sorry.
I'm certainly happy to refer it, for edits by Jeff and/or our fiduciary counsel, who has a lot of experience with retirement systems, especially serial systems. I certainly can seek feedback from some of the labor groups if that's the direction of the board. The individuals who know this material are really staff and myself, because we work with the serial and we understand, I think, much better now than perhaps in the past, some of the requirements of the law that we need to ensure are incorporated in the handbook and explained in a clear and concise manner to our membership.
Okay, great. I'll just follow it along.
Any other trustee conversation or discussion regarding the work plan or the item Trustee Shoemaker brought up regarding the handout? I'm not seeing any, and still no public in attendance, so we will take item 10, the board work plan and strategic calendar quarterly view, as received and filed. Brings us to item number 11, discussion and possible action regarding board policies. There's 3 items: the board communications policy, the SACR's voting proxy authority policy, and the board election policy. Executive Director Rentschler.
Thank you, Chair Cromer. The board communication policy and the SACR's voting proxy authority policy are really just being updated to change the verbiage from retirement administrator to executive director. There were no other substantive changes to those 2 policies. The board election policy, you may recall, as having been adopted just a few months ago. It is being further updated to incorporate a requirement of the FPPC, which actually requires candidates running for a position on this board to file a Form 700 as part of their candidacy. So that's really the only change to that policy, was the addition of having candidates complete the Form 700 prior to taking office.
That's a new requirement?
I do not know when it went into the state regulations on that, but it is part of the FPPC information on their website and on the elections board's website.
That's good. Should have always been there, but that's good.
Do you have any other trustee board member discussion regarding these 3 proposed policies? Seeing none.
Mr. Chairman, I'll move staff recommendation on all 3.
I'll second.
We have a motion and a second. No members of the public in attendance for public comment. Seeing no other trustee comment, let's take a roll call vote.
Mr. Hawkins?
Aye.
Ms. Cavanaugh?
Aye.
Mr. Jurdy?
Aye.
Ms. Smith?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Approved.
Next up would be item number 12 on our agenda, discussion regarding the administrative report, and once again, Executive Director Rentschler.
Thank you again, Derek Romer. In the update, I did mention that our fiduciary counsel, Nossanen LLC, and Ashley Dunning, our primary attorney with them, have submitted increased rates for calendar year 2023. They do continue to offer us the longevity and small plan discount. These do represent a modest increase in their hourly rates. As a reminder, the Form 700 will be due by April 1st. Please turn that into Judy. There's a couple of updates regarding pension gold help desk tickets. One of them is the item regarding the PEPRA compensation that we discussed earlier regarding how that's reported in PG. The other was an issue with how salary is projected for estimates, and we've worked out a way to improve the estimates that members create for themselves within Pension Gold. We do have the retirement seminar coming up. I believe the target date is actually the first week of March. And we did sign a 2-year extension with the state for the lease of Suite A. We also have issued the request for quotations for architectural services, and the due date for those quotes is February 10th, if I recall correctly. There's also information regarding the SACR's board. If you're interested in being a member of the SACR board, you have until March 1st to submit your application, and there's a legislative update. There's also upcoming board training opportunity, which is the Calipers Advanced Principles of Pension Governance. I'm told that that is a very good event, and I wanted to make sure people knew, because the registration deadline is the end of next month. If anybody was interested in attending, please contact Judy.
Trustee Smith.
I will add on that, I have taken that twice, and I learned something both times. The first time it was in person before the pandemic, and then a year or two ago it was online. And so I participated a second time, and it is a very, very good educational opportunity if you're interested.
And this is back in person.
Yes, it is. In LA. It was in somewhere much nicer than LA when I went.
Yeah, well, Oakland first year.
No, not where, I can't remember, but it was down south. Pepperdine.
Pepperdine,
Yeah,
yeah.
Malibu.
Yeah.
Malibu, Pepperdine University.
My old
There is
stomping
a
grounds.
Session in August.
Oh, there is. Oh, that's better than.
For the same
LA.
advanced principle.
It is, well,
That
in the
was-
Trustee Education and Training Report.
Okay. Pepperdine was where the initial one, not the advanced one was.
Yeah.
when I
Yeah,
went.
I think it's the,
I'll just personally comment on the pre-retirement seminar. I don't know what I expected as far as interaction or responses, but I was, I guess, a little pleasantly surprised we had some participation there. I think 100 responses is probably higher than we usually get on most interactions with the flyers or other surveys we send out. So, and to even see that some of them came from PEPRA members that are obviously, many of which are a little further in retirement, but they're interested in hearing more about it at this stage. So I was happy to read that personally.
it is the principle of pension governance, so it's the beginning.
The initial
first
one.
In August.
That's where it was highlighted on the candidate.
And then this is the advanced one running in March.
Any other board member discussion regarding the administrative report?
Mine would be to Kathy, seeing what we pay our attorneys. I think we should have gone into law instead of it.
Instead of education. I know, that hourly rate is amazing.
And that's with the discount.
I know.
I'm not seeing any members of the public in attendance, so I'm assuming we don't have public comment on the administrative report, which takes us to general board member discussion, item number 13. Any general board member trustee discussion? Anybody attend trainings or anything else recently they'd like to report on? Go ahead, Trustee Anderson.
Just an informational item for the board members. A committee of Catherine Smith and Richard Shoemaker and myself have been working on the executive director evaluation form. And staff, Judy and Maddie, have been extremely helpful. They've got all the skills for creating a form. And so we have a draft that we'll hopefully bring to the board in February. We're asked Doris to place it on the agenda for the board's review and consideration.
Thanks to Jen for doing the work.
Trustee Harris, you had brought up a comment right coming out of break about an out-of-state training. I don't know if that would benefit the other trustees to hear. There is the annual Callan conference, correct?
Is in Arizona.
It's in Arizona this year, which is not offered in our state, and it's a little bit different for travel and reimbursement. So, Executive Director, if you could explain that, the additional layer of approval we get on those, if anyone's interested in going.
Certainly. There is the capacity to have out-of-state travel. It does require approval in advance from the executive office before that travel is booked. I think historically, there wasn't a lot of desire to try to get those approved, or maybe they hadn't been successful. But I do know when I reached out to the executive office regarding the Pension Gold teaming conference that is only held in Illinois, that they did approve Judy's request to attend, because there isn't any local training comparable to that we could use. So if there is a desire, we can certainly put in a request and see what the executive office says, and see if we can get that approved if there is an out-of-state training that someone wishes to attend.
The question on that, this is the money that we administer, correct? Doesn't come out of county funds.
It doesn't, but even though we are an affiliated agency and technically not a department, we have, for the most part, followed all of the county's policies, including their travel policy, and purchasing policies and things like that. So we probably could find a way to look at getting doing out-of-state travel without having to get the executive office to approve. But we have followed that, especially for employees, because the staff has to follow the county process.
And we do have trustees that are also county employees.
We do.
So having attended the Callan, their big conference, it's excellent and helped a great deal. Various areas to go in enriching my knowledge.
I believe it is a 3-day conference. I've only been able to obtain the April 2nd date. I'll have to follow up with Greg and Claire to confirm what the true dates are. That's from the Callan website.
It is Phoenix area, what you found? Scottsdale. All right. Seeing no other general board member discussion, that'll lead us to notice of our next Board of Retirement meeting, which is Wednesday, February 15th, 2023 at 8:30 a.m. and that we will be adjourned. Thank you all.
Thank
Have a great
you.
month.
Good job.
Well done, Chair.
Thank you.
Nice management of the meeting.
Yes, he did real well. He did, very professional too.
However, hearing